Well, a very good morning and afternoon to everyone, depending on where you are joining from. Welcome to today's webinar to launch our new publication. My name is Sin-Young Park. I'm Director of the Regional Cooperation Integration in ADB's Economic Research Department. It is my great pleasure today to welcome everyone to this book launch webinar. First, let me introduce ADB's Vice President for Knowledge Management and Sustainable Development, Dr. Bambang Susantono, to deliver his welcoming remark. VP Susantono is responsible for managing knowledge in ADB and coordinating research projects on various topics such as energy, transport, water, education, health, finance, digital technology, and other cross-cutting nexus themes, including climate change, environment, governance, gender equality, and social development. He holds a PhD in infrastructure planning and 2 master's degrees in transportation engineering and city and region planning from the University of California, Berkeley. Without further ado, the floor is yours.
Thank you, Dr. Sin-Young Park. A very good day, good afternoon from Manila, the Philippines, and a pleasant morning or evening to those elsewhere around the world. On behalf of Asian Development Bank, it is my pleasure to join you all to today's webinar. We are pleased to launch our new publications, Non-Performing Loans in Asia and Europe, Causes, Impacts, and Resolution Strategies, which was jointly prepared by ADB and the European Central Bank, or ECB. I'm grateful that our colleagues from the ECB for a very fruitful partnership over the past years. This book could not be timelier during this pandemic. Even after almost 2 years, the pandemic continues to plague the world with uncertainties and threaten an uneven, fragile recovery worldwide. Businesses have become highly indebted and are vulnerable to any deteriorating economic and financial market conditions. With extraordinary monetary policy accommodation, very low interest rates have also contributed to unprecedented corporate borrowing. Rising non-performing loans, or NPLs, could undermine banks' ability to intermediate credit and support economic recovery. These concerns have renewed and even increased the focus on NPL resolution strategies in many economies to restore banking sector soundness and strengthen their resilience. Drawing on experiences and lessons from Asia and Europe, this book will be a valuable policy guide as we navigate the turbulent waters. Let me briefly review Asia's NPL situation and its possible implications. Banking system across most of Asia entered the pandemic in better shape than past crises, thanks to stronger regulation, supervision, and capital buffers. But NPL ratios have been creeping up in some countries, close to or above the worrisome 10% level. This is particularly true for some Central, East, and South Asian economies, and we could see NPLs rise further. These heightened NPL risks, along with elevated debt levels, threaten financial stability and economic recovery. Economic theories and the evidence we have at hand suggest that high NPLs negatively affect output and employment. Also, the economic slowdown and inflation lead to a rise in NPL levels, highlighting the macro-financial feedback effects of NPLs. These relationships are clearly illustrated in the slide. So, what should we prepare for? The phasing out of monetary policy support and regulatory forbearance could prompt deterioration in credit conditions and quality. The economic consequences of the pandemic crisis and limited financial resilience have raised concerns. Our study evaluates a range of policy options to address large-scale NPL stocks. These include complementary debt write-offs and market-based disposal solutions. We propose a comprehensive NPL resolution framework that will effectively reduce NPL stocks by balancing the different incentive, costs, and risks of banks, investor, debtor, as well as national authorities and taxpayers. Let me close by highlighting 3 key lessons that can address the potential risk from high NPLs and safeguard regional financial stability. First, past experience shows the need for a comprehensive NPL resolution framework to manage NPLs swiftly and effectively. What's more important is to prevent a build-up in NPLs by introducing or strengthening prudential regulations. We need to reinforce banks' incentive to resolve NPLs. Second, to help with the swift disposal of NPL, it is very important to develop NPL markets. This allows financial institutions to dispose of distressed portfolio at fair and efficient market prices. And third, crises have taught us that we need stronger regional financial cooperations. To avoid banking and financial crisis, the region's policymaker must work together to better identify, mitigate, and respond to this risk as we chart a new path to an inclusive, sustainable recovery. Distinguished colleagues, ladies and gentlemen, the pandemic impact on the banking sector has yet to materialize fully. Once temporary debt relief programs and other policy support measures are unwound, banks will likely face a wave of non-performing loans. Given the anticipated rise in NPLs, I look forward to the panel discussions to share insights about how we can manage orderly exits and what options can be availed for early resolutions of NPLs without compromising post-pandemic recovery and financial stability. With that, I thank you very much for your participations. Have a good discussion and stay well. Thank you again.
Thank you, VP Susantono. Let me now turn our floor to a representative from the European Central Bank to give a short, also the welcome remark. Mr. John Fell is Deputy Director General for Macroprudential Policy and Financial Stability at ECB. He is also the chair and co-chair of several international working groups, including the Eurosystems Macroprudential Policy Group and the European Systemic Risk Board's Instrument Working Group. John holds postgraduate degrees in economics and finance from University College Dublin and Dublin City University, respectively, and is a PhD candidate at the Rotterdam School of Management, Erasmus University. The floor is yours, John.
Thank you very much, Sin Young, and good morning to those of you joining us from Europe, and good evening to those of you in Manila or elsewhere in Asia. So first, let me convey the apologies of our Vice President, Luis de Guindos, who had wanted to be with us today, but because of an important scheduling conflict is unable to join us. He has been a very strong supporter of this project, and as you may have seen, he has also co-signed the foreword to the book, and he's asked that I take his place in making these welcoming remarks. So I have been involved in the ECB's work on NPLs since the very beginning. Just after the global financial crisis, the ECB was invited to join the European Commission and the IMF to help in designing and monitoring macrofinancial adjustment programs for a number of euro area countries. At that time, bank recapitalization and ensuring liquidity were the most immediate concerns on the financial sector policy side of those programs. However, it quickly became clear that the crisis was going to leave a legacy of non-performing loans that had the potential to weigh on the economic recovery. Indeed, by the time the ECB had become the single banking supervisor for the euro area in 2014, total non-performing loans in the euro area banking sector exceeded €1 trillion, or about 8% of total loans. Now, European policymakers recognized the potential repercussions of this NPL burden on the banking sector, and coordinated action was taken. The ECB diagnosed the state of the euro area banking sector, required banks to adjust the provisions, and to develop strategies for NPL reduction. We also raised policymakers' awareness of the failures that were afflicting the market for NPLs in the euro area. The market was illiquid, it was highly concentrated on the buy side, and it suffered from information asymmetries. On the regulatory side, European governments adopted an EU-wide action plan in 2017, which aimed at improving supervision and insolvency frameworks, and also developing NPL markets. Now, the idea of a book which would set out the lessons learned from the euro area approach to NPL resolution emerged in 2017 at a time when the issue was at the top of the regulatory agenda in the euro area. Our Asian colleagues have provided valuable insights to us based on their experience from the financial crisis. So it was only natural that we should write this book together. Now, the book covers 4 areas. It starts by investigating NPL developments in Asia and Europe. Then in part 2, it examines the determinants and consequences of high NPLs for the real economy. Part 3 is dedicated to country case studies, and it documents the multifaceted nature of NPL problems and solutions. And finally, part 4 distills the policy implications and recommendations. Now, the book was largely complete at the time of the outbreak of the COVID-19 pandemic. At that time, most commentators were expecting a rapid rise in NPLs, but the outcome in Europe contrasts somewhat with the picture for Asia just painted by Vice President Susan Tona. Our latest ECB financial stability review shows that NPL outcomes have been consistently lower than even the most optimistic forecasts of corporate default rates in the euro area. Our analysis shows that these better than expected outcomes can be explained by the unprecedented direct fiscal support to firms, including grants, wage subsidies, and loan guarantees. Statutory moratoria on loans to firms also helped. So faced with a sudden loss of revenue, firms were able to avoid insolvency and continue making payments to employees and suppliers. And that in turn supported those firms which did not benefit from the fiscal intervention directly. Typical domino effects where firms default on each other, fire staff, and spread distress through the real economy were prevented by these measures. Now, while none of those actions were aimed at directly supporting banks, they did so indirectly by minimizing corporate defaults. At the same time, demand for NPLs from investors remained strong, and euro area banks were able to dispose as much of their legacy NPLs in 2020 as they did in 2019. And the result is that euro area banks managed to reduce their NPL ratios to levels that were not seen since before the global financial crisis. And market analysts now expect that asset quality is going to remain robust over the next 2 years. Now, that does not mean that the policy options that are presented in the book have lost their relevance. The business models of some economic sectors may require an overhaul, and we cannot exclude delayed effects of the COVID-19 pandemic on NPLs. At the same time, with new waves of the virus, governments may not have sufficient fiscal space to deliver similar support in the future. So if and when NPL problems materialize in the future, I think the collective European and Asian experience identifies necessary conditions to deal with an overhang of NPLs, and it offers a menu of solutions. Now, my co-editors, Maciej, Peter, and Rainer, are now going to talk you through the key messages of the book, and I'm sure that our panelists will share their rich experience in the subsequent discussion as well. I would like to wish you a productive session, and although I would not wish anyone to have to deal with a problem of high NPLs, I nonetheless hope that if you find yourself in need, this book will provide a compass for you. Thank you.
Thank you, John. Thank you very much for a very encouraging, welcome remark. I'm very pleased to have 3 of the co-editors of the book join us today to make a presentation about the book. So let me introduce these. First, Peter Rosen Krentz, who's an economist in ADB's Regional Cooperation Integration Division in the Research Department. His work has been focusing on the financial development, stability, integration, and cooperation in Asia. Rainer Martin is lead economist at the Joint Vienna Institute from Vienna, Austria, He has been developing and delivering a wide range of financial sector training courses, including those on NPL management and resolution. Until August 2018, he was deputy head of the ECB's macroprudential policy division. Maciej Krotzyki, who's an advisor in the Systemic Risk and Financial Institutions Division of the ECB. He also works extensively on issues in the euro area banking sector, including asset quality, bank profitability and consolidation, and calibration of capital buffers for systemically important banks. So Peter, Rainer, Maciej, very good to have you. Floor is yours. Thank you, VP Susantono. Let me now turn our floor to a representative from the European Central Bank to give a short, also the welcome remark. Mr. John Fell is Deputy Director General for Macroprudential Policy and Financial Stability at ECB. He's also the chair and co-chair of several international working groups, including the Eurosystems Macroprudential Policy Group and the European Systemic Risk Board's Instrument Working Group. John holds postgraduate degrees in economics and finance from University College Dublin and Dublin City University, respectively, and is a PhD candidate at the Rotterdam School of Management, Erasmus University. The floor is yours, John.
Thank you very much, Sin Young, and good morning to those of you joining us from Europe, and good evening to those of you in Manila or elsewhere in Asia. So first, let me convey the apologies of our Vice President, Luis de Guindos, who had wanted to be with us today, but because of an important scheduling conflict is unable to join us. He has been a very strong supporter of this project, and as you may have seen, he has also co-signed the foreword to the book, and he's asked that I take his place in making these welcoming remarks. So I have been involved in the ECB's work on NPLs since the very beginning. Just after the global financial crisis, the ECB was invited to join the European Commission and the IMF to help in designing and monitoring macrofinancial adjustment programs for a number of euro area countries. At that time, bank recapitalization and ensuring liquidity were the most immediate concerns on the financial sector policy side of those programs. However, it quickly became clear that the crisis was going to leave a legacy of non-performing loans that had the potential to weigh on the economic recovery. Indeed, by the time the ECB had become the single banking supervisor for the euro area in 2014, total non-performing loans in the euro area banking sector exceeded €1 trillion, or about 8% of total loans. Now, European policymakers recognized the potential repercussions of this NPL burden on the banking sector, and coordinated action was taken. The ECB diagnosed the state of the euro area banking sector, required banks to adjust the provisions, and to develop strategies for NPL reduction. We also raised policymakers' awareness of the failures that were afflicting the market for NPLs in the euro area. The market was illiquid, it was highly concentrated on the buy side, and it suffered from information asymmetries. On the regulatory side, European governments adopted an EU-wide action plan in 2017, which aimed at improving supervision and insolvency frameworks, and also developing NPL markets. Now, the idea of a book which would set out the lessons learned from the euro area approach to NPL resolution emerged in 2017 at a time when the issue was at the top of the regulatory agenda in the euro area. Our Asian colleagues have provided valuable insights to us based on their experience from the financial crisis, so it was only natural that we should write this book together. Now, the book covers 4 areas. It starts by investigating NPL developments in Asia and Europe. Then in part 2, it examines the determinants and consequences of high NPLs for the real economy. Part 3 is dedicated to country case studies, and it documents the multifaceted nature of NPL problems and solutions. And finally, part 4 distills the policy implications and recommendations. Now, the book was largely complete at the time of the outbreak of the COVID-19 pandemic. At that time, most commentators were expecting a rapid rise in NPLs, but the outcome in Europe contrasts somewhat with the picture for Asia just painted by Vice President Susan Tona. Our latest ECB Financial Stability Review shows that NPL outcomes have been consistently lower than even the most optimistic forecasts of corporate default rates in the euro area. Our analysis shows that these better than expected outcomes can be explained by the unprecedented direct fiscal support to firms, including grants, wage subsidies, and loan guarantees. Statutory moratoria on loans to firms also helped. So faced with a sudden loss of revenue, firms were able to avoid insolvency and continue making payments to employees and suppliers. And that in turn supported those firms which did not benefit from the fiscal intervention directly. Typical domino effects where firms default on each other, fire staff, and spread distress through the real economy were prevented by these measures. Now, while none of those actions were aimed at directly supporting banks, they did so indirectly by minimizing corporate defaults. At the same time, demand for NPLs from investors remained strong, and euro area banks were able to dispose as much of their legacy NPLs in 2020 as they did in 2019. And the result is that euro area banks managed to reduce their NPL ratios to levels that were not seen since before the global financial crisis. And market analysts now expect that asset quality is going to remain robust over the next 2 years. Now, that does not mean that the policy options that are presented in the book have lost their relevance. The business models of some economic sectors may require an overhaul, and we cannot exclude delayed effects of the COVID-19 pandemic on NPLs. At the same time, with new waves of the virus, governments may not have sufficient fiscal space to deliver similar support in the future. So if and when NPL problems materialize in the future, I think the collective European and Asian experience identifies necessary conditions to deal with an overhang of NPLs, and it offers a menu of solutions. Now, my co-editors, Maciej, Peter, and Rainer, are now going to talk you through the key messages of the book, and I'm sure that our panelists will share their rich experience in the subsequent discussion as well. I would like to wish you a productive session, and although I would not wish anyone to have to deal with a problem of high NPLs, I nonetheless hope that if you find yourself in need, this book will provide a compass for you. Thank you.
Thank you, John. Thank you very much for a very encouraging, welcome remark. I'm very pleased to have 3 of the co-editors of the book join us today to make a presentation about the book. So let me introduce these. First, Peter Krentz, who is an economist in ADB's Regional Cooperation Integration Division in the Research Department. His work has been focusing on the financial development, stability, integration, and cooperation in Asia. Rainer Martin is lead economist at the Joint Vienna Institute from Vienna, Austria. He has been developing and delivering a wide range of financial sector training courses, including those on NPL management and resolution. Until August 2018, he was deputy head of the ECB's Macroprudential Policy Division. Maciej Krotzycki, who's an advisor in the Systemic Risk and Financial Institutions Division of the ECB. He also works extensively on issues in the euro area banking sector, including asset quality, bank profitability and consolidation, and calibration of capital buffers for systemically important banks. So Peter, Rainer, Maciej, very good to have you. Floor is yours.
Thank you very much, Sinyoung, for the very warm introduction, and I'll be pleased to start our joint presentation discussing the main findings of the book. Next slide, please. Allow me to start very briefly on presenting a brief overview of the book structure, which has already been mentioned in the remarks a bit. So we really have it structured into 4 parts, consisting of 2 chapters each, whereby each part usually has 1 chapter focusing primarily on Asia and 1 chapter primarily focusing on Europe. Starting with some introductory chapters on NPL trends. Part 2 empirically examines macrofinancial implications of NPLs, both for Asia and Europe. We have a part 3 on country case studies that go into in-depth experiences across Asia and Europe with regards to NPL resolution responses and effectiveness thereof. And finally, part 4 discusses policy considerations with regard to NPL resolution strategies in Europe and Asia, including forward-looking ones. Next slide, please. So what you can see here are on the left-hand panel NPL ratios of sub-regions in Asia, so average NPL ratios in Asia on the left-hand panel, and on the right-hand side it's European countries, including also Euro area average. And what's first and most visible is that both regions went through really NPL surges in the last 2 decades, and those were linked to specific periods of financial distress. So for Asia, it can be observed that during the Asian financial crisis, 1997, 1998, there have been surges, most particularly in South and Southeast Asian economies. Thereafter, there's been downward trend with some spikes during the global financial crisis, though not as visible as, for example, compared with some European countries, which we can see in the right-hand panel, where they were really steeply rising during the GFC, as well as the subsequent European debt crisis. So one important lesson here still, or some important observation, if you want, there's still a couple of countries that have entered the pandemic with rather elevated levels. So there's not an overall pattern for Asia, but especially South and Central Asian economies entered the pandemic with elevated levels, which gives some sort of rise to concern, or at least some rise to monitor carefully. As the pandemic, let's say, enters the recovery period, there will be the phasing out, as mentioned in the remarks earlier, of some potential regulatory forbearance, policy normalization, and we will discuss this also more on the panel, what potential implications would have on the NPL ratios, both in Asia and in Europe. Next slide, please. So we do look into macrofinancial implications of non-performing loans through some empirical chapters. The common finding is that high NPLs can really impair banking sector stability and its ability to financially intermediate. So for example, chapter 3, using Asian data, finds harmful macrofinancial implications of NPLs. For example, as you can see in the chart below, which is linked to chapter 3, a shock to an NPL ratio results in a decrease in loans growth, but also has some real economic effects in the sense of an increase in the unemployment rate and a reduction in real GDP growth. Very much in a similar vein, chapter 4, focusing on European data, finds similar findings whereby NPL ratios, so increases in NPL ratios, depress bank lending in the euro area, widen bank lending spreads, and also lead to a fall of GDP growth and even residential real estate prices. So against the backdrop of the nature of the financial systems that in Asia and Europe, where most countries have very strong banking sectors compared with other sources of financing, this is even more of a reason to really thinking about options to deal swiftly with NPLs as they arise. Next slide, please. So in the book, we identify a range of impediments to NPL resolution, and we categorize these in supply side, demand side, and also structural problems that hamper NPL resolution. And I'd like to go through these briefly and highlight a couple of the common findings. So supply side challenges really stem from banks' reluctance to take the losses that NPL resolution entails, being concerned that it would hurt their profitability in the short run and reduce capital levels. So instead, banks really prefer to keep NPLs on their books, hoping that they would eventually become performing, or at least the underlying asset value would recover. But in the case studies that we also discussed in the book, it is shown, or we show that these hopes are often unfounded and ultimately may result in even more severe balance sheet losses for those banks. Some additional supply side constraints are NPL sale restrictions, for example, prohibiting the selling or restructuring of NPLs at discount. Turning to demand side impediments, banks tend to have more information about the NPLs than potential investors, which creates information asymmetries between potential buyers and sellers. And those information asymmetries do not necessarily contribute to a well-functioning NPL market. It can even lead to some market failure. Second, the transaction cost for resolving or selling NPLs are often rather significant, further impeding the demand for NPLs. So these costs, for example, could relate to cost of collateral valuation or the legal cost of recovery. Furthermore, some countries have legal barriers in place restricting potential investors from entering and actively participating in these NPL markets. Those could be domestic or foreign investors. And these demand side impediments tend to drive down actually the price that potential investors are willing to pay, and thereby widening the so-called bid-ask spreads, about which we will talk also a bit more in this presentation. Last point would be structural and legal impediments. These relate to the existence of poor legal frameworks, poor legislation, or lack of sufficiently transparent collateral enforcement or insolvency proceedings. These in turn can result in lengthy insolvency procedures, again adding to recovery costs and further widening bid-ask spreads. All of these impediments will slow NPL resolution and limit investment into NPL markets and hence prevent these from functioning efficiently. Next slide, please, and I'll be most happy to turn over to Rainer.
Okay, thank you very much, Peter. Let me continue from here. So, John mentioned in his introduction that the book should provide a compass for those looking for solutions to NPL problems. And we always thought about it also as a toolbox, because we are discussing a lot of different options, a lot of different instruments that are available to deal with NPL problems and to resolve NPLs. And this chart here provides a very comprehensive overview and a very dense overview of these tools that are available. And the chart is organized that it starts from on-balance sheet solutions. So the banks are dealing with the problems, with the problem loans, distressed assets themselves. And it goes to off-balance sheet solutions where assets are moved away from the bank balance sheet. So a starting point is the internal workout. So the originating bank deals with the loan that has become non-performing. And of course, to do that, they have various restructuring options at their disposal. The second step, so to say, the second instrument would be asset protection schemes, which imply a risk-sharing agreement. These are usually state-backed and usually also cover only a short horizon. So they are particularly suitable for periods of acute crisis when the potential losses from NPL are large, but the probability of this risk occurring is actually low. And the third instrument is securitization or synthetic securitization. And this is often seen as an alternative to outright sale. It implies only a partial risk transfer from the bank. It can also be made more efficient by co-investment by the state. There are a few drawbacks, though. It's to use this tool successfully, a certain depth and sophistication of financial markets is normally required. So in very small jurisdiction, it's probably not a very promising approach. Then the fourth instrument are asset management companies, often also somewhat unfortunately referred to as bad banks because they're not really banks and there is nothing particularly bad about them. So asset management companies imply a complete separation of assets from the originating banks. And these are often state-backed. They are often for a relatively long period of time, and the losses have typically already realized. I'll discuss this in a little more detail in a minute. And the last option are classic direct sale. So the originating bank sells the distressed asset to an investor, often a specialized investor. And this is sometimes difficult to create working markets for this, and Maciej will discuss this in a little bit more detail. Next slide, please. So not all these tools are suitable for all different situations. And this is the key message of this slide here. So, and in fact, it's a key message of the book. Country-specific conditions determine the right combination of NPL tools or NPL solutions. So bespoke but comprehensive options are needed. And in the table, it shows you that which of these tools that I described before are suitable for what sort of situation. And we're distinguishing here between the nature of the shock. Is it slow growth or is it actually an acute crisis? What are the mainly affected asset types? Is it mortgages? Is it small company loans, large corporate loans, or unsecured loans? And what is the fiscal space of the country concerned? And also, what are the legal constraints? And as you can see, many of these tools are suitable for many situations, but there are some notable exceptions. So, for example, public AMCs don't tend to be very suitable for NPL problems that are focused on the mortgage sector. And also, when it comes to securitization, this is something that is difficult to use when it's mostly large corporate loans that are in distress. So there are some exceptions here that are important to keep in mind. Another point we emphasize is that resolution by the banks should always be part of the solution mix. So even if there are other options in place, like an AMC, working securitization schemes, and so on, the banks should always be put in a position that they are able to do their share of the problem solution, so to say. And the last important point here is that market-based solutions are very promising and very desirable, but often suffer from market failures. And again, Maciej will discuss this in a little bit more detail. Next slide, please. So let me just elaborate slightly on the asset management companies. There's a lot of references to such entities in the book because they have been used both in Asia, but also in Europe quite successfully in many countries. But what also shows is that they are only successful if they are properly designed and properly managed. And they have some notable advantages. So normally they do not require large startup costs. This is a big plus. But publicly owned AMCs are nevertheless contingent liabilities, at least for the public sector. And this is something that should be kept in mind. Experience also shows that asset transfers to the AMCs should be informed by diagnostic exercises. So ideally a combination of an asset quality review as well as a stress test. So that provides you with a point in time and also a forward-looking assessment of the asset quality. And the information you get from this is very important to determine both the appropriate transfer price, this is absolutely crucial for the success of the AMC, but also the scope of the assets to be transferred and the banks that should be involved in this transaction. Turning more to operational issues, it's important, sometimes difficult, but very important to find the optimal scale and scope of the AMC. If a large chunk of non-performing assets is transferred in a certain asset class, this enables it to realize economies of scale. At the same time, if there's a very large number of loans being transferred with very granular nature, that increases the complexity of the entity. In any case, operational independence, even if it's a publicly owned entity, and professional management of the AMC is very important preconditions to improve the business results. And lastly, there's been some interesting and different views emerging from the work between Asia and Europe on whether AMCs should be permanent structure, so permanent part of the financial crisis management infrastructure, so to say, or should they be temporary entities that should be wound down once the crisis is over? So there are different views on this, and this is elaborated also in the book. On that, over to you, Maciej.
Thank you. So as Rainer said, I'll focus mainly on market solutions to NPLs, and I'll start off with this rather complex chart here, which serves just the purpose of showing you that the impediments that Rainer and Peter and others have already discussed at length have a really tangible price and a tangible effect on NPL valuations. Now, very importantly, NPL markets are private. Price transparency in these markets is very limited, and active NPL trading is taking place only in some countries, both in Europe and in Asia. So what you see here are estimates of a theoretical price that a very standardized generic NPL investor might be willing to pay for a portfolio versus what a bank would be carrying that portfolio at. And there are two main issues I wanted to highlight with this chart. First, the blue bars that represent the cost of recovery can lead to a significant discount from the gross value of an NPL. These are taken from the World Bank, and as you see, they exceed even 20% of the exposure in some cases. And they are important because they're generally not recognized upfront in the bank's books because they represent future costs. But as a future cost, they would be taken into account by an investor, and they directly contribute to the gap between what investors would be willing to pay and the prices that banks would be willing to accept. We have similar data for Europe that show also that judicial recoveries can be costly, up to the level of several percentage points of the exposure. But in addition to cost, there's another element. Because insolvency procedures are lengthy, because their outcome might be difficult to predict, because there may be multiple competing creditors, and because NPL information supplied by the bank to the investor can be weak, all of this would lead the investor to demand a rather high expected return for taking the risk of holding these assets. And in this particular example, the investor required return is assessed at 25%, which I think is high from a European perspective, maybe more standard from an Asian perspective. The precise calibration doesn't really matter, but all that matters here is that the green bars are also another important contribution to the gap between investors' expectations and the bank's expectation. And that leads to illiquidity and lack of trading in the NPL markets. So let's move on to the next slide to go through a couple of elements of a strategy needed to unlock potential of NPL markets. This is a really multi-tier, multi-pronged strategy consisting of several building blocks which reinforce each other. And I start first with supervision. So supervisors should make sure that banks do not assess their NPLs at an overly optimistic value. Rather, they should ensure that NPLs are recognized timely and that the valuation are conservative to make sure that there's no additional obstacle to deal with them. Second, as I said, reforms of legal and judicial frameworks for debt enforcement are essential to shorten the time and to reduce the risk involved in workout of NPLs, and then to directly compress the bid-ask spread. Then third, I already spoke about data. Data quality is often a stumbling block for NPL transactions. It definitely would cost much less to improve the data upfront than it would to sell a portfolio with bad data quality. So here, banks and their supervisors should also work to make sure that data definitions are harmonized, consistently implemented, and well recognized across the market. Now here, transaction platforms and data warehouses are a vehicle that can help disseminate data and allow investors to identify business opportunities more efficiently in the NPL market. Rainer spoke at length about asset management companies. So here, I would only say they often help catalyze growth in the NPL markets because they are, as well as banks, they are a user of the NPL market. They treat it as a disposal channel. So we're not calling for setting up AMCs just for the sake of making NPL markets more efficient, but we know they can create positive externalities. And then finally, our experience from Europe is a case in point that regional cooperation can be key. So many smaller countries in Europe would be on their own too small to achieve a critical mass for NPL markets. But because of the fact that a lot of this work on NPL data supervision and even some elements of the work on judicial and legal frameworks has been done at the European level, that helped these small countries move towards a more single, more harmonized, more integrated capital market, including NPL market in Europe. So where NPL problems are regional in nature, such coordinated action may be beneficial. And finally, let me go to the last slide, which recaps the key takeaways from the book, which people already mentioned. So first, the book emphasized there's no silver bullet, there's no one size fits all, and bespoke solutions tailored to the context are the best way forward. Second, it is really important to identify and realistically assess and diagnose the problem early on, so that we know what type of asset quality problem we're dealing with and how costly it is going to be. We should also not forget about operational aspects and capacity to deal with the problem. And very often in normal times, the judiciary and the banks and bank workout departments are simply not prepared for what may happen in the surge of NPLs. That leads to bottlenecks and delays if not addressed. Address obstacles to NPL market development, which I just went through that, and also work on your legal framework. So our experience is that it's hardly possible to finalize a full reform of a legal framework in an NPL crisis. So ideally, that should be done proactively before problems build up. But often this is done.
I think we lost Maciej.
I think, yeah.
But he was just finished.
Frozen, so he was just
finished with the last one.
So, thanks, Peter, Rainer, and Maciej for a very concrete, though brief presentation. Well, we are very privileged to have distinguished panel to continue the discussion under the theme of navigating COVID-19 recovery, how to manage non-performing loans amid policy normalization. As mentioned during the presentation, the book provides a very useful toolkit. Nonetheless, these have to be selectively chosen, customized to fit the context and also country condition as well as the current situation. I hope that the panel can bring us how to link these the framework with the current context. So let me introduce quickly our distinguished panelists. First, Ms. Chuchi Punasia. She is Deputy Director of the Financial Supervision Sector at the Philippines Central Bank. In her capacity, she is mainly responsible for the resolution of banks and other BSP supervised financial institutions, and also chairing the executives meeting of East Asia Pacific Central Banks working groups on banking supervision, comprising central banks and the supervisory authorities from 11 countries in the East Asia and the Pacific region. We also have an honor to have Ms. Piroska Nagi Monakshi, who is now currently visiting professor at the London School of Economics and former director at the EBRD. She is currently with the Firouz Lalji, it's a bit difficult to pronounce, Institute for Africa, sorry, Pulia, at the London School of Economics, and a political science and partner of a macroeconomic advisory group in New York. And we also have Mr. Bostjan Yazbek, who's the board member of the Single Resolution Board. He's also director of resolution planning and decisions. He's responsible for the banks under the direct remit of the SRB in 6 EU member states and for 2 global systemically important banks. He's also chair of the cross-border crisis management group for banks at the Financial Stability Board. Last but not the least, we have Mr. Chinan Kong, who's the co-head of the principal investments for Asia, Pepper Financial Services Group. He has over 19 years of experience as a senior executive banker and advisor in corporate finance, also specializing in financial services, mergers and acquisition. He's currently leading the Pepper Group in business and expansion in East and Southeast Asia. Before, he led Deloitte's portfolio lead advisory services in Asia and was a part of the senior executive team leading the successful deleveraging of Lloyds Banking Group's £300 billion of non-core assets. So, welcome and thank you very much for joining this interesting panel. Well, as mentioned, that I think a lot of the information that we got from the book is also open for application in country-specific and context, based especially against the current context of the COVID-19 and upcoming recovery. So, Ms. Chuchi, where are we in the Philippines? What is the NPL situation? And has the pandemic affected the NPL trend? Or what is your expectation for 2022 once the monetary and fiscal support wanes?
Yeah, thank you very much, Sin Yong, for your kind introduction. Before I start, allow me first to congratulate the ADB and the ECB on the publication of the comprehensive book on NPL management and resolution in Europe and Asia amid the COVID-19 pandemic. And I thank the ADB and the ECB for the opportunity to participate in this event and contribute to discussions in this area. For the next slide, let me start by sharing the NPL situation in the Philippines. So the NPL ratio of banks has increased during the pandemic. Prior to the COVID-19 crisis, the NPL ratio of the banking industry was at 2%. Latest available data show that this has increased to 4.4% as of end September of 2021 on account of double-digit growth in NPLs coupled with slowdown in bank lending. The BSP estimates that the NPL ratio of the banking system may range between 5% and 6% by end December of this year, 2021. And this generally coincides with industry estimates derived from the BSP's Banking Sector Outlook Survey, a survey which gathers sentiments of leaders from the banking industry. And the BSP expects that the NPL ratio of banks will remain in single digit in the coming years, well below the double-digit NPL figures recorded during the Asian financial crisis. Now, over to the next slide. The manageable asset quality of banks may be attributed to their strong financial position as well as sound risk governance. Over the years, the BSP has put in place a policy framework that has promoted prudent risk-taking behavior in banks. And prior to the pandemic, the BSP strengthened the guidelines on corporate governance and risk management. And this was followed by the adoption of the IFRS 9 and the institutionalization of the BSP supervisory enforcement framework. And so this set of rules pushed banks to improve their lending policies and practices in the areas of credit underwriting, loan loss provisioning, and problem account management. And by the time the COVID-19 crisis unfolded, banks had already integrated sound credit risk management in their operations. At the national level, the government adopted support measures to help households and enterprises cope with the crisis. And these include the enactment of 2 bayanihan laws. And if I may describe, bayanihan would refer to the Filipino custom demonstrating unity and cooperation of the community. So said laws mandated financial institutions to grant a uniform grace period to their borrowers. And meanwhile, the BSP complemented these efforts by espousing a tailored approach in the grant of financial relief by banks to the borrowers. And this means banks and borrowers are given the flexibility to arrive at mutually agreeable terms, considering both the risk-bearing ability of the bank and the paying capacity of their borrowers. And the BSP also issued guidance on the prudential treatment of the various support measures to provide clarity in their implementation. And under the said rules, the BSP emphasized that supervised institutions should continue to practice prudent credit underwriting and be able to distinguish between accounts of borrowers that are experiencing temporary cash flow pressures from those with deeply rooted solvency issues. So learning from our experience during the Asian financial crisis, the BSP actively lobbied for the passage of the Financial Institution Strategic Transfer Act, or the FEAST Act for short. So the FEAST Act encourages financial institutions to dispose of their non-performing assets to privately owned asset management companies. And the FEAST Act has reinforced confidence of the public in the financial system by serving as a standby facility for banks to dispose of their NPAs in case these sharply increase. And recently, the BSP adopted twin relief measures, which will sustain financing to borrowers in step with expected uptick in economic activity. So the first guidance reminds supervised entities to modify loan terms based on changes in the projected cash flows of their borrowers. And under the BSP issuance, modifications to loan terms that are suited to the borrower's circumstances would result in the loan being classified as performing. And the second guidance lends further support by softening the impact of provisioning requirements on these performing loans on the bank's capital. So in particular, the capital relief allows banks to add back the net increase in the sum of their stage 1 and stage 2 provisions to their common equity tier 1 capital, subject to a declining add-back factor. So the declining add-back factor helps reduce the cliff effect of the measure upon its expiration. And it also recognized that the need for such measure will decline over time in line with the recovery of the economy. Now, if I may share some of the lessons which we have learned from our experience, and that's over to the next slide, in managing NPLs during this pandemic. So first, the BSP is mindful that the pandemic is still ongoing. So the continuing threat of the new COVID-19 strains may cause economic activity to remain muted and affect the long-term paying capacity of the borrowers. Nonetheless, the progress on the government's rollout of COVID-19 vaccines can abate such effect. And second, the BSP recognizes the need to ensure smooth transition between changes to temporary relief measures and their eventual phase out. So for instance, the BSP managed the impact of the shift away from the legally mandated grace period by ensuring that the BSP prudential relief measures would be in place upon its expiration. And third, a deeper understanding of the NPL dynamics requires amendments to existing surveillance analytics. So at the height of the pandemic, the BSP conducted ad hoc surveys and stress tests to cover periods in between regular reporting intervals and capture scenarios that are more in line with latest developments. So the BSP's early investments in supervisory technology help support achievement of this objective even during periods of limited mobility. So moving forward, the BSP will institutionalize certain aspects of these ad hoc exercises in our surveillance model. And lastly, financial supervision needs to be strengthened to ensure consistent application of prudential expectations. So to level understanding, engagements in the form of coordination meetings, briefings, and focus group discussions are regularly undertaken among supervisors and with supervised institutions. So the BSP has adopted a blended approach to financial supervision during the pandemic. And active engagement with stakeholders provides avenues for collaboration and information sharing on the BSP's policies and gain feedback on their effectiveness. So let me now stop here. Thank you, Sin Young.
Thank you, Mr. Chi. Well, very comprehensive presentation, and then it's great to learn how BSP has been responding to the development of NPLs in the Philippines. Ms. Piroska, so what's the situation in Europe? I mean, John earlier mentioned, in fact, the COVID didn't really lead to an increase in NPLs, but he also warned that was mainly because of the very strong fiscal stimulus that was provided to save the corporate sector. So what is your view? How is going to change as we move along through this pandemic recovery phase?
Thank you very much, Senya. It is a real honor to be a part of this phenomenal book launch and to be together with the participants in this illustrious panel. Thank you, ADB and ECB, for having me. And just reiterate, I congratulate and salute the co-authors. All of them has been already in the screen. This is a phenomenal reading, cannot be more timely. It reads like a crime story for those who have been one way or the other associated with crisis management in the Asian crisis and then more recently in the European twin crisis. So it should be a must read for the industry, banking industry, for regulators, and I think academics and students. Next slide, please. In my comments, I will be drawing on a joint work with Rainer Martin, who is one of the co-authors of this great book, as well as Elina Rybakova and Jonathan Vargas from the IIF. An interesting element, at least looking from the European perspective, but I think it's a general point, is that this crisis is different, and the COVID NPLs is different. This time is different. Is coming from Carmen Reinhardt and Ken Rogoff's book. You will recall, countries always say that this time is different, our crisis is different, but in fact, it's always the same story. But the COVID crisis has been a very unique crisis, and importantly for the NPL discussion, of course, this crisis has not started, as opposed to many others, from the financial crisis. So that is kind of the background, the important background, sort of macro point. But there are two other unique elements why this COVID NPL crisis is different. One is much better preparedness in Europe, at least, but I understand also in Asia, in the wake of the global financial crisis and the Eurozone crisis. And for that, just read the book, listen to the presentations we just heard. What I would focus on the second important element, and this is what I would call the whatever it takes policy with European characteristics. Now, the whatever it takes, of course, is borrowed and widely used, now became a very well coined and then cited term from Mr. Draghi, then the ECB president, which set out the strategy to save the Eurozone, to put it very briefly. I think this type of whatever it takes policy has been extended during the COVID pandemic to the policy mix as such. The massive anti-cyclical policy mix that is well described included major fiscal support, direct or indirect. But what I would emphasize is that it has integrated for the first time, as far as I can see, macroprudential and regulatory policies in a systemic way in the policy mix. So we don't have just the traditional fiscal and monetary policy mix and a strong anti-cyclical sort of massive support stimulus, but it has been in a coordinated way also supported by macroprudential regulatory policies. This is a new thing, I think, related to under this crisis. Second, at the EU, this required, and the EU has reacted very fast, an EU-level easing. The suspension of the fiscal rules, the Stability and Growth Pact, in a across the board way, and importantly also complemented by a suspension or relaxation, depending how you interpret this, the state aid rules and competition rules, which manage actually and limit in normal times government intervention in the sector. This was a real first, so very well done, congratulations. And finally, I would mention that the ECB has been, on the top of its game, a very enlightened monetary policy easing, which actually extended beyond the Eurozone. This is the first time the ECB has acted as a real systemic big central bank on pair with the Federal Reserve. It has extended to non-Euro countries also Euro liquidity, so currency swaps and repos. This was not the case. It was very difficult during the global financial crisis. If colleagues in this panel recall, Borja certainly will. But this time, this was different. This has been offered extensively, almost unlimited. Listening to the coalition governor, the central bank governor's assessment, this has really made a difference at the peak of the market turbulence in March 2020. So bravo to the ECB for moving and covering its whole monetary sphere of interest with the appropriate liquidity policies. Next slide, please. The key elements, just put the two charts. There is much more than in our joint work and elsewhere in also of these policy elements of this huge policy stimulus, fiscal support measures that you see on the left-hand side chart. And it compares US and the EU, and it's important for the MPL discussion, so let me spend just 1 minute on this. Overall, the direct and indirect, so contingent liabilities, indirect guarantee support has been broadly the same magnitude in the US and the EU, around 25, 27 percentage point of GDP, huge, as we all know. The difference is the composition, and in the EU, the direct government support was 10 percentage point GDP, sort of smaller part of the package, and most of it actually came in the form of contingent liabilities, guarantees, bank loans, and others. That's one. The other one is that Europe has lent, right-hand side chart, has been an industry leader, so to speak, in terms of bank regulatory measures to support this policy mix, as I described earlier. In this chart, the type of top bank regulatory measures are depicted. This is a chart from the IIF colleagues, by the IIF colleagues. It shows capital, liquidity, provisioning, and relaxation of timetable and other types of measures. And it shows that in terms of a number of regulatory measures, the EU at the top of the chart has been the main leader. And if you look at some of the Asian countries down below, Indonesia or China, this has been very little. Let me mention that the guarantees and debt moratoria, also mentioned by John Fell in his introduction, have been very effective. According to a bank survey under the Vienna Initiative, which covers emerging Europe, 80% of parent banks and subsidiaries have used, 80% have used government guarantees at some point in the crisis, and they all of them have said that it was the most important policy element supporting their operations. Next slide, please. So what are the results? Let's look at the chart. This depicts the blue line, the NPLs. And in contrast, what I understand is going on in Asia, actually, we are seeing a continued decline in NPLs in the EU. The latest numbers are, well below, sort of just slightly above 2%. In emerging Europe, it's a little bit over 3%, it's slightly higher, but the trend is the same. So that's the big surprise. And indeed, as John Fell has said, this is probably the result of the combination of direct and indirect support mechanism, including the guarantees in Europe that have taken place. But we have to know that there is change incoming, and maybe I would be a tad more circumspect in my optimism than John has been regarding NPLs and asset quality going forward. We do see a divergence between the nicely reducing recorded NPLs, the blue line, and the stage before being declared, the so-called stage 2 loans. That's almost NPLs, but not yet non-performing by the definition, which is the red line. As you see, there is the divergent trend starting from March 2020, and the stage 2, the precursor to the NPLs, actually have started to rise and are 2 percentage points higher than at the lowest point at the beginning of the crisis. So that's a little bit of, of note at least. Also, the stimulus measures, these massive measures, are going to be wound down. The early evidence is that it's not disruptive. That's good, but a lot will be happening in conjunction with the fiscal stimulus withdrawal, the quantitative easing, at least tapering, and regulatory measures. So we have to be vigilant. And there are some clear risks. The asset prices are soaring, the household and corporate debts are rising. That is a concern, as we heard earlier from the vice president in Asia as well. There is a risk of zombification. And I would stress that in emerging markets, an emerging market part of Europe, there is a potential for negative spillovers following the tightening in advanced Europe. So going forward, and my last slide, please. I think we need to be vigilant here. There will be no systemic, nobody expects a systemic big NPL increase. But the underlying risk and trends are a little bit of concern. So speed is of the essence to deal with them. I very much agree with all the speakers who have spoken to that. In our joint paper, we also, with Rainer and others, we also suggest to use the benefit of the doubt principle. So move, and as the deputy governor emphasized, be preventative in avoiding any NPL increase. We specifically suggest also to take a fast-track approach on calls-on guarantees. As I showed, some 60% of government support has been in the form of guarantees. If they are called on, of course, subject to bank capacity to deal with them, but if they are called on, there should be a fast-track approach to recognize those guarantees, and this should be set up now. Just as many other speakers said, secondary NPL markets should be strengthened. There is a host of lessons learned, and the book is a great guidance in that regard. I also echo colleagues speaking to the importance of asset management companies, the bad banks, with a bad term. But that we have to recognize in Europe requires also more flexible state aid rules. We also say that in the case of an NPL wave, EU level AMCs also should be considered. This is a complicated issue because of the mutual risk sharing and the different legal jurisdictions, but still an important point. Fine. Last but one point, we believe that given the uncertainty, it would be important to include into the forward guidance also regulatory issues to communicate to markets what is happening. Also, it's very good for transparency, honestly, that the public understand how the regulators move in generally in regulatory areas, but particularly on NPL management in these uncertain times. And finally, the very last point, a broader point. Emerging markets and emerging Europe, in the case of the European continent, will face much more pressure with the tapering, as the tapering is starting and the withdrawal of stimuli will be happening. And for emerging Europe, it will be extremely important that the ECB maintains in this phase as well the currency swaps and repo arrangement that have been critical in mitigating market overreaction during the COVID crisis, and will be critical, in my view, to avoid any market overreaction at the time of the forthcoming tapering. Thank you very much.
Thank you, Pivoska. Well, let me turn to Mr. Jasbek. Well, globally, inflation has picked up, and eventually monetary and fiscal support will have to be wound down. So do you foresee a buildup of risks to financial stability, especially as many major central banks are prepared to raise interest rates given the high inflation? What will be the risks to the NPLs, and how should we be prepared?
Thank you very much for this invitation first, and then congratulations to ADB and ECB for this extremely important book, and then thank you very much for this very important question. I didn't prepare any slides. I want you to be more flexible, and I want to piggyback on things that have been said already. But let me answer your question with three general remarks. First, straightforward answer to your question is yes. I do believe that we will have increase in the NPLs, not only because of the inflation pressure and then change environment, but also because of the COVID reflection on everything what has happened. To me, maybe I have a serious personal issue of understanding what is really happening with COVID, because for me, having lockdowns for almost 2 years and now seeing all this economic revival is maybe I completely misread my textbooks when I was doing my studies. I don't really understand how the revival of the markets is possible without having any effect on the banks. The answer might be in particularly in Europe, with a massive government subsidy support, forbearance loans, and then everything that we do not see yet on the balance sheets of the banks, and that might pops out on our table sooner than later. And then we are, at least in my book, still in the same framework environment as we've been 10, 15 years ago at the great financial crisis. So what have we learned from that time? And then what is the thing that we are constantly avoiding? The best way to deal with NPLs is that banks have enough capital. And we haven't mentioned that the only probably long-term solution for banks dealing with NPLs is they have available capital to cover up for NPLs. We're trying to find a ways with different toolbox, but at the end of the day, if banks do not and owners do not provide enough capital, then we are stuck with NPLs. This is something that we still have legacy of the last financial crisis in Europe, while we have this rather disguised piling up of NPLs that, at least in my view, will have to be dealt with. So, what are the lessons that we have not learned in Europe from 2008 to 2012 crisis? First, I think that we missed the opportunity in 2014 when we had the comprehensive European asset quality reviews and stress tests, which helped us to standardize something that is called non-performing loans. We had in all banking union members rather standard asset quality reviews, and then these somehow standardized the assets that were not performing. And for that, and then you might soon recognize that I'm a staunch supporter of something called NPL the platform. We should offload all those NPLs to the platform, and then try dealing with the NPLs in a more managed, structured way, but we missed that in 2014, and then it is very hard to imagine that today anyone would dare to go into the asset quality reviews as we did in 2014. Why? Because that would reveal that the balance sheets of the banks are much more fragile than we thought or we think they are. So in this respect, also supervisors are missing the point in progressive provisioning, because again, for progressive provisioning, you need a lot of capital to do so, and this is again something that we are trying to surpass, to trying to avoid. And in the years from 2014 to pretty much a couple of years ago, there was enormous search for yield when central banks started with a low interest rate policy, and then the search for yield was something that the banks, us as the regulators, did not take advantage of, and this was somehow now substituted with the whole new cryptocurrency world, where obviously nobody wants to deal with something as difficult as NPL, while everyone can go into the digital crypto and then everything else, and then it is something that we don't know, we don't understand properly, and it is for sure something that is easier than deal with the NPLs. So coming back to my third remark, particularly in Europe, I think Piroshka correctly alluded to and mentioned there is enormous difficulty with the state aid rules in Europe. I mean, you cannot offload the NPLs without having first, if there is no private capital, you have to take into account the state aid rules. The state aid rules are very restrictive, of course. Restrictive, particularly for if it doesn't happen at your own backyard. If it can start happening in your own backyard, then the state aid rules can be very easily bended. But this is political issue in Europe and in this respect. Second thing is resolution framework in Europe is enormously fragmented. We do. I think that in Europe the gravely misused adjective is European. We do have European compendium of national resolution frameworks, but we don't have anything that would call European resolution framework in this respect. Why? Because we still have insolvency legislation that is primarily national, and in this respect, the insolvency legislation greatly determines also the resolution framework. And in this respect, then coming to the toolbox that I think Rainer very nicely presented from the book, we do have resolution impediments that come from supply side, demand side, and of course the structural side. But for me, the supply side can be sorted out. The structural legal issues can be sorted out. But we have enormous difficulty with demand side. Why? Because investors usually come to the banks, come to the asset management companies. They said, "Look, you have a problem, and we have a money. Let's close the door." And then after the negotiations, you usually end up with a price for NPLs much lower than before the negotiations, because you want to offload that, and investors know that, and that's why nobody wants to get into the more structured, more determined and defined market for NPLs. And then there is this perverse situation where investors do not want to have more managed and then more defined NPL markets, because everything is much easier done on bilateral basis, of course, with the prices at the end much lower than before. And then which end result is that banks need even more capital there. So the status quo there is that supervisors, regulators, bank owners, bank lobbyists play the same game. Let's pretend that the NPLs are not there. Let's pretend that maybe we should define them a bit differently, like it's happening now in Europe. All of a sudden, we're talking about the different tranching of the NPLs, and then you see the countries like Italy and Greece all of a sudden substantially reducing the value of NPLs, and then you can see that it is only the accounting tricks that are being played around, and then everybody is playing the same game, because particularly in Europe, we have a problem of enormously overbanking sector, with enormous cost-to-income ratio. I can give you an example of the banks that are running the cost-to-income ratios over 100%, which means that for every euro they are making, they have to pay, and they are still on the market because nobody dares to clean up the market. And then if you add on top of this the very strategic, and here I stop, very strategic way forward, namely to fully embrace the digitalization, which means that what if central banks indeed introduce the central bank digital currencies? Then the substantial part of intermediation for current understanding of the banking system will be gone away. So that means that banks will at some point become redundant in the way of intermediating what we know today is a basic principle of intermediation in this respect. And then the second thing, which is the climate.
Mr. Yazbek, let's go back to those, maybe new adoptions of technologies later.
Let me finish. The thing is that there will be enormous cost to the banks on top of the NPLs, and we have a problem, and we don't have the solutions yet. The books, what books does is that nicely lays out the different aspects, but still, I guess, it is very smart from authors not to provide any conclusions in a way what to use, because I think that the NPLs are, at the end of the day, not that much of economic but a political issue. Thank you.
Thank you. Thank you, Chinan. Well, we heard about these kind of fragmented markets in Europe. I actually also see the evolution of the NPLs in across Asia and Europe show quite diverging patterns. But together with Europe, we also face a very underdeveloped market to help resolve the NPL issues in Asia. What do you see as the NPL market development in Asia? Do you see that it's going to be an issue when we have to tackle the rising NPLs post-pandemic?
Yeah, thanks for that. And again, congratulations on the book. I think it's probably one of the most comprehensive reads I've had, being in the NPL industry for some time. And yes, Asia is like Europe, it's fragmented. It's also culturally different, linguistically, and also quite different. Not just in terms of Roman numerals, but Sanskrit versus Chinese characters versus quite a diverse, continent, right? Compared to Europe, and I had the benefit of comparing the two, given my time since the 2008 crisis, and now I'm in for round two. I'm not old enough to be round three, but I think the development of the markets in Asia in terms of NPL markets is quite fragmented as well. Similarly with the insolvency and legal regimes, right? Yeah, and it goes. I think there has been a lot more consistency in Europe generally because of how EU has wrapped its hands around various regulations over a number of years, right? Yeah, things like data privacy, and I think Raina mentioned about data asymmetry, and needing to provide fair information to investors as they look at stuff. There is a difference in even the level to which you are allowed to provide information, right? Yeah, in Asia itself, the data protection rules in Thailand is only coming into force June next year. And China is now really tightening data protection, as people can see. But in Singapore and Hong Kong, it's already been around for some time, right? So there's quite a differences in terms of regulation and law around the region. And because of the legacy around different markets and the evolution of the banking markets, again, it's been different. So China embraced the AMC model in the last crisis, in Asian financial crisis 2000, and it's never stopped, right? And it's the same for Thailand. In terms of Philippines, because of the economic situation, they've done it differently. So they had a sunset on the AMCs, and when now the SPV Act, Jushi, correct me if I'm wrong, then we have now the FIST Act, and it's an improved version of the SPV Act, which is great, which is a sunset methodology for a 5-year, right? Yeah, you solve the problem, you move on. Some countries have developed a more it's almost like you're implementing a tool potentially if needed, right? Yeah, to apply, but it's a mechanism at that point in time, right? Yeah, and then you have other markets who embrace it more as a long-term resolution tool, like Thailand and China, right? Yeah, I don't know how India will pan out, but India has now created the AMC. They've spoken out for some time, and there's been a higher and higher level of trade. I guess the other countries, so the challenge that we have now is, unlike Europe, where it's kind of never finished, from my experience, in clearing up its NPL levels since the last crisis properly, right? Yeah, and that's for a variety of reasons, and not for lack of effort from the banks, to be honest, right? Or the governments and things like that. Asia is now restarting its journey, right? Yeah, and for those with already a trading market, secondary market, like Korea, right? Like China, like Thailand, they will benefit from that. Not so much because the mechanisms are not in place, but because the engine is not started in a number of other countries. Yeah. So I guess the challenge for Philippines in this case would not be so much the mechanism doesn't work, but how do you get the participants in place to get the machine to work again, right? And things have changed, right? The world's moved quite a bit since 98 to 2003-4, right? Laws have changed, regulation have changed, markets have changed, investors have changed, lawyers have changed, right? Governments have changed, regulators have changed. So a lot of so when I look at these things, you have to look at it in the context of the process and the stakeholders. And on those two axes, in deep understanding of those two things, you can assess the ability for the market to be ready to adapt or not. Yeah. So I'll stop there for a moment in terms of what I see in the market. And I think there will be a fair amount of NPLs, as pointed out by the colleagues on the floor. It's the same latent credit risk that is observed across the industry, across the countries, to be honest.
Thank you. Well, given the time, let me maybe give this one sort of a question for all to kind of like suggest the key takeaways as a wrap up. So what are the main challenges in development of the NPL markets in Asia? And also, in fact, compared to Europe, which has started building some kind of a region-wide regulatory cooperation framework, and having at least like a forum to discuss these fragmentation and discussion. Asia has not been able to institutionalize some of these regional framework. So what could be the policymakers in the region to like allow this type of the cooperation to address the collective challenges? So Chuchi, like from the Philippines point of view, what are the main challenges and how you would like to address?
Yeah, thank you for that, Sinyong. Actually, the Philippines does not have a secondary market for the trading of NPL portfolio. So even though the Philippines passed a Securitization Act in 2004, actually as a companion law to the Special Purpose Vehicle law, which was also issued in 2002, there has really been minimal interest in securitization here. So the depth and structure of the domestic debt capital market needs to be developed to be able to accommodate secondary NPL transfers or securitization arrangements. But the other measures that may facilitate transfer of NPLs from the financial system, whether on a bilateral basis or through established markets, include first should be there's a presence of a recognized body of professionals experience in NPL asset valuation, consistent with international valuation standards to arrive at a valuation that could attract banks and investors in the NPL market. And then second, there should also be improvements in the judicial system to help reduce debt enforcement costs. And third, the development of skills to provide specific external credit ratings on securitized assets to support the NPL market. I think that's from the Philippine side. Thank you, Sinyong.
Thank you. Piroska, what were the lessons, from the tackling of the spillovers of European sovereign debt crisis, and how do you address the challenges to and barriers to developing the NPL markets in Europe?
Thank you very much for the question. I am not an NPL market expert, so let me put it maybe in a kind of broader context, and I'll leave that more technical but very important aspects to the other participants to respond to. But I would stress that what would be important is to use all the policy elements which are at disposal in order to solve or prevent, as the Vice President said, prevent an NPL wave. So in addition to focusing on NPL markets, which I agree is very important, use the regulatory tools when the time is here, and use the asset management companies, the AMCs as well. In addition, the specialty now in Europe is these huge guarantees which can be called on. And again, as I was making the point, I think it's important to just fast track if they are called on, and not to linger and not to risk zombification and of these issues. But finally, let me stress that we have to be very, very careful. Bostian alluded to sort of and said this is almost not comprehensible what's happening in terms of macroeconomic policies and crisis response, given the uniqueness of this crisis. I think it's a phenomenal crisis response that has been mounted with all the issues and all that. That's for a separate discussion. But it's very important to have a gradual and well thought through exit from the support mechanism, so that not to endanger the recovery, which is the most important thing. Thank you.
Thank you. Mr. Jasper, what, in your view, what are the major challenges for developing the NPL secondary trading market? I mean, you actually also experienced in the large NPL stock in Slovenia, and the AMC in Slovenia. Like did the Slovenian experience with the AMC, was it helpful? Mr. Jasper, can you unmute yourself? Yeah.
Our experience in Slovenia and the rather unfortunate the outcome at the end was as much as the BMC was state owned. There at the end was a lot of political pushback in terms of setting up and then continuing with something that the central bank wanted to set up, namely the NPL platform. And then you can see also in Europe last year, the SSM chair or ECB came up with an idea of maybe setting up the European platform for NPLs, but was very quickly killed at the very beginning. And this is something what I said in my presentation, namely, there is a resistance, not only from banks themselves, but also political resistance, and particularly in Europe. We have a problem because we do not speak about European banking system, but we speak about 19, now 21 different national banking system that try to cohabitate in something that we call European banking system. And this, in my view, is now the main hindrance and then prevention of making the NPL market really working and helping the failing or ailing banks in this respect. Thank you.
Thank you. Chinan, well, you're the only financial sector, private sector participant here. So, but if you can maybe suggest the region's policymaker and like what priorities that we should consider in helping the development of the NPL market, what would that be?
Can we split it into two halves, right? So for the markets that are matured, right, yeah, and already having secondary market, the question would be, how can let's just say policymakers make the market more open, more transparent, and to welcome further foreign direct investment into the country itself. Because I think there's more than one benefit to resolving an NPL problem. And from my experience, everybody thinks about, oh, how can I help the banks and resolve issues? But the other way to look at it is that there is a lot of investment into countries, and these things can grow and become very useful tools for the environment, for the investment. For those countries that don't have a market yet, right, or don't have a proper functioning market, to be honest with you, that each country has its own issues, so it's a bit difficult to have a one-size-fits-all solution. But what I do advocate is 2 points there. One is use an AMC to kickstart the market as a catalyst, yeah, but don't use it as the be-all end-all, right? Yeah, don't make it a national institution to absorb all the AMCs, because I think you will have issues with it for many reasons. But use it to kickstart things. That's one thing I'd say. And secondly is one thing which I think a number of countries in Asia, I mean, it's my own personal view, hasn't got into the mode of is actually thinking about how an NPL secondary market is a long-term or part of the risk management tool of a financial system ecosystem, right? Yeah, such that people get used to the fact that yes, because when I was in Lloyd's, I spoke to many senior people and said, look, Chenang, manage some yourself, outsource some, and sell some, right? Yeah, and then you get a balance of a portfolio in terms of what you do, because you can't really know, right, until you do a bit of each, right? Yeah, and having a secondary market ecosystem, which when I started in Europe, they didn't have a secondary market, but now it's pretty evolved, right? And I hope that one day that the policymakers will think that way and allow that to happen. And actually, I see that there is a lot of benefits because it's a natural extension of credit resolution, right? Our credit issues resolution.
Thank you. Thank you for very useful, practical suggestions. And as already we are past the time allocation that we have, but I hope everybody have enjoyed as much as I did of this fruitful conversation. And really thank you all for joining us today, and also all participants presenters for excellent messages, and then also the sharing sharing the findings from the presentation. Thank you. I hope this discussion has been helpful for all. Good night. Thank you.
Thank you. Thank you.
Thank you very much. Thank you.
Thank you. Bye.
Thank you.
Bye.
Bye-bye.
Bye-bye.
Thank you. Bye-bye.
Thank you. Bye.